Candlestick patterns are powerful tools that traders use to analyze the market to make informed trading decisions. In our previous video, we saw how to use Fibonacci retracement, and we saw that candlestick patterns are relevant for confirming the signal from the Fibonacci retracement. Candlestick patterns are also relevant for confirming signals from support and resistance. So in this video, we are going to be looking at 6 important single candlestick patterns. So yes, there are single candlestick patterns, double candlestick patterns where you need 2 candlesticks to form a pattern, and even up to triple candlestick patterns where you need up to 3 candlesticks. But in this video, we are going to be looking at 6 important single candlestick patterns. As the name implies, single candlestick patterns are individual candlesticks on charts that traders use to analyze market trends and predict price movements. On the chart, you will notice that candlesticks are red and green. For some charts, they are white or black. A candlestick is made up of 4 key components that are important for trading. First, the opening price. This is the price at which an asset begins to trade at the start of a specific time. So if you are using a 1-week time frame, the opening price will be the price the asset started to trade at the beginning of the week. For a 1-hour time frame, it will be the price the asset started to trade at the beginning of the hour. Now the closing price, this is the price at which the asset finishes trading at the end of a specific time. So it represents the final transaction price recorded when the candle closes. We also have the highest price, which is the highest price got to during the time frame, and the lowest price, as the name implies, the lowest price got to during the time frame. And we can see on the red and the green candlestick where the opening price, the closing price, the highest price, and the lowest price is. Notice how it is different for the red candlestick and the green candlestick. Now, like I said earlier, the opening price, closing price, highest price, and lowest price will depend on the time period you are looking at. So you should keep in mind that if you are looking at a 1-week time frame, each candlestick on the chart represents 1 week. Same goes for if you are looking at a 1-hour time frame. Each candlestick on the chart represents 1 hour. So for any time frame you are looking at, each candlestick will represent the duration of the time frame. So for example, for a 1-day time frame, each candlestick represents 1 day, and then the opening price for that candlestick will be the opening price at that day. The closing price will be the closing price at that day, and then the highest and lowest prices will be the highest and lowest price for that day. Same goes for 1 hour, 1 week, or 1 month, 1 year, whichever time frame you are using. Also know that the difference in the opening and the closing price will determine whether a candlestick is bullish or bearish. If the closing price is higher than the opening price, the candlestick will be bullish, that is green. And if the closing price is lower than the opening price, the candlestick will be red, that is bearish. Now let's just quickly run through how to identify the opening and closing prices on a candlestick. Now for a green candlestick, that's a bullish candlestick, the opening price is at the bottom of the body and the closing price is at the top of the body. And for a red or bearish candlestick, the opening price is at the top of the body and the closing price is at the bottom of the body. Now what this indicates is that price decreased during the period of time. And as you should know, the candlestick wicks or shadows represent the highest and the lowest prices during the period. Now that you understand how to identify opening prices, closing prices, highest prices, and lowest prices on a green and red candle, let's carry on to discuss single candlestick patterns. So first, let's start with the Doji Candlestick pattern. The Doji Candlestick patterns are one of the most important and versatile candlestick patterns in trading because they represent market indecision. When you see a Doji candlestick on the chart, it means that neither the buyers or the sellers are in control. So you notice that price is closing almost at the same point where it opened. The appearance of a Doji candlestick indicates trend reversal or continuation of the current trend. Just for the fun of knowing, the word doji is a Japanese word that means simultaneous occurrence, and it reflects the close proximity between the opening and the closing prices. There are 4 main types of doji, and each has its different characteristic and implication. So follow through and observe closely so you can identify the different types of doji and know what each of them imply. First, a standard doji. To identify a standard doji, you should keep in mind that the opening and closing prices are almost identical, resulting in a thin or non-existent body. The upper and lower wicks are of similar length. Now, when you see a standard doji on the chart, it means market indecision. Neither buyers or sellers are dominating. Second, the long-legged doji. A long-legged doji is a doji with a long upper and lower wicks, showing significant price movements in both directions before closing near the open. What a long-legged doji means is that there's intense market indecision, but this time around with volatility. It often appears before significant market moves. Next is a Dragonfly doji. To identify a Dragonfly doji, you should know that the open, high, and close prices are at or near the same level, with a long lower wick but little or no upper wick or shadow. You should know that when a Dragonfly doji appears at the bottom of a downtrend, it means that there's a potential bullish reversal. Now lastly, a Gravestone doji. In this doji, the open, low and close prices are at or near the same level, with a long upper wick but little or no upper wick. Now, what the Gravestone doji means is that there's a potential bearish reversal, especially when you see a Gravestone doji appear at the top of an uptrend. It means there's a potential bearish reversal. Now you know the different types of doji, and you know that doji implies that there is market indecision. But where a doji appears and the type of doji that appears can determine whether you should expect an uptrend or a downtrend. Let's carry on to discuss the 3 key rules for analyzing doji patterns. First, the location on the chart. Like I already mentioned, the significance of the doji depends on where it forms. When a doji forms at the top of an uptrend, it means that there's a possible reversal. So you may be expecting a reversal to a downtrend, or it means that there's just a pause to the uptrend and it may continue. When you notice a doji at the bottom of a downtrend, it also means that there's a possibility of a trend reversal to an uptrend or just a slight pause of the downtrend. Now, when you notice a doji during consolidation phase, it means continuation of the existing trend. So if you notice a doji during consolidation, but the existing trend is an uptrend, it means that the uptrend is likely to continue. Same goes for when you notice a doji during consolidation phase, but the overall market trend is a downtrend. It means that the trend only paused and the downtrend is likely to continue. Remember, we are talking about the 3 key rules for analyzing doji patterns, and we've looked at its location on the chart. Now, the next key rule when analyzing doji patterns is confirmation. Always wait for a confirmation before you use the signal from a doji pattern to make trading decisions. A strong bullish or bearish candle following the doji can validate reversal or continuation. If you notice a doji candlestick after which you notice a strong bearish candle forming after it, it may signal a downtrend. So you want to wait to see the next candlestick that's going to form after the doji candlestick before making any decision. Thirdly, volume analysis. A high trading volume accompanying a doji enhances its reliability as a signal. Let's discuss the trading strategies that you can use when using the doji pattern for signal. Now, if you're a risk taker, place a buy or sell order immediately after the doji forms if it aligns with your analysis near a support or resistance level. You can set your stop loss just above the high, that's for a bearish trade, or below the low for a bullish trade. If you are not a risk taker, then it is a good idea to wait for the next candlestick to confirm the trend direction before entering a trade. You can set a slightly wider stop loss based on the recent swing high or swing low for additional safety. Before we move on to the next candlestick, here are some things you should keep in mind about the doji candlesticks. First, a series of doji often signals a breakout, so watch for consolidation patterns like triangles or rectangles. Next, be careful when you see a doji in isolation. So be careful when trading doji that appear without support or resistance context. Next, dojis should be used in conjunction with indicators like the relative strength index, MACD, or moving averages. The next single candlestick pattern on the list is the hammer candlestick pattern. A hammer candlestick is a single candlestick pattern that forms at the end of a downtrend and signals reversal to an uptrend. It is characterized by a small real body near the top of the candle and a long lower wick that is at least twice the size of the real body and a small or no upper wick. The hammer reflects strong buying pressure after initial selling during the trading session. The small body on the hammer candlestick indicates that the opening and closing prices are close to each other, showing a lack of significant price change. The lower wick must be at least twice the height of the real body, showing that the market pushed lower but buyers regained control and drove the prices higher before the close. The little or absence of the upper wick indicates that the session ended near its highest point, reinforcing the strength of the buyers. You should also know that the hammer candlestick typically forms at the bottom of a downtrend, where it signals a potential bullish reversal. The hammer candlestick is formed when the price opens and sellers initially push the price lower, creating a long lower wick. Buyers step in and push the price back up, closing the session near the opening price. This price action reflects a tug of war between buyers and sellers, with buyers gaining the upper hand by the close. Now, what does a hammer candlestick indicate? The hammer is a bullish reversal pattern that shows buyer strength, and traders interpret the hammer as a sign that a downtrend may be losing momentum and the bullish sentiment could be returning. Although we already know that the hammer candlestick is a bullish reversal pattern, and so where it appears at the bottom of a downtrend, traders take it as a signal to go long. However, you should wait for a price confirmation. Your trading decision should not be based solely on the fact that you saw a hammer candlestick at the bottom of a downtrend. Wait for the next candlestick to form, and if the next candlestick that forms is also a bullish momentum candlestick, then you have confirmed that there's a signal to buy, that's go long. Now let's see how to trade the hammer candlestick. First, you want to wait for confirmation. Next, you want to combine hammer candlestick with support and resistance. A hammer candlestick that forms near significant support zones or Fibonacci retracement levels carry more weight. If you do not understand Fibonacci retracement, then you may want to see our video on Fibonacci retracement. I'll leave a link to the description below for that video. To trade a hammer candlestick, you also want to complement it with indicators like RSI, MACD, moving average to confirm oversold conditions and bullish momentum. To trade using the hammerhead as signal, you want to enter a long trade after confirmation closes above the hammer's high. Place a stop loss below the hammer to protect against false signals. Let's carry on to the shooting star candlestick. A shooting star candlestick typically appears at the top of an uptrend and signals a trend reversal to downtrend. This pattern reflects strong selling pressure after an attempt to push price higher during the trading session. Now, here's how you can identify a shooting star candlestick on the chart. First, a shooting star candlestick has a small body near the lower end of the candlestick that shows that the opening and closing prices are close, despite an earlier attempt to push price higher. The upper lower wick must be twice the length of the body, showing that buyers drove the price up significantly, but sellers regained control and pushed it back down before the close. A shooting star candle has little or no lower wick or shadow. A minimal lower wick or none at all indicates that the market closed near the session's low, reinforcing the bearish sentiment. Like I mentioned already, the shooting star candlestick typically forms at the top of an uptrend or near a resistance level where it signals a bearish reversal. A shooting star candlestick is formed when the market opens and buyers push the price significantly higher during the session, creating a long upper wick. Sellers step in, rejecting the higher prices, and push the price down to close near the opening price. This price action shows that sellers have taken control despite the initial bullish momentum. How do you trade shooting star candlestick pattern? First, you want to wait for confirmation. Do not trade based solely on the formation of a shooting star candlestick at the top of an uptrend. Wait to see the next candlestick that forms. If the next candlestick that forms is a bearish momentum candlestick, then you've confirmed that there is a bearish market sentiment and prices are likely to go down, and then you can now open a sell trade. You also want to combine the shooting star candlestick with resistance. A shooting star candlestick near a significant resistance zone is more reliable. And as you know, you should complement with indicators like the RSI, moving averages, MACD, as well as Fibonacci retracement tool to confirm the bearish momentum that's about to start. After confirmation, you can enter a sell trade below the shooting star's low. And then you can place your stop loss above the high of the shooting star to protect against false signals. Let's move on to the inverted hammer candlestick pattern. The inverted hammer is a single candlestick pattern that appears after a downtrend and signals a potential reversal to the upside. This pattern reflects a struggle between buyers and sellers, but finally, buyers are able to push the price high after a downtrend. Here's how to identify an inverted hammer on the chart. An inverted hammer has a small body. The small body near the lower end of the candlestick shows that the opening and closing prices are close despite the attempt by the buyers to push the price higher. It has a long upper wick. The upper wick must be twice the length of the body, indicating that buyers try to push the prices up significantly during the session. It has little or no lower wick, and a minimal lower wick or none at all signal that the market closed near its opening. Like I already mentioned, the inverted hammer forms at the bottom of a downtrend or near a support level, suggesting potential bullish reversal. An inverted hammer forms when the market opens and buyers drive prices significantly higher, forming a long upper shadow. Sellers step in and push the price back down, but the close is significantly above or close to the opening price. This price action reflects initial buyer strength, hinting a possible shift in momentum. Now, how do you trade with an inverted hammer? First, you want to wait for confirmation. Do not enter a trade just because you notice that an inverted hammer has formed during a downtrend. You want to wait to see the next candlestick that forms after that inverted hammer. Only enter a trade when you've confirmed a trend reversal from bearish to bullish. You also want to combine the inverted hammer with support. An inverted hammer that forms near a significant support zone is more reliable. Like I already say in other candlestick patterns, you want to use indicators, RSI, MACD. You can also use the Fibonacci retracement tool, moving averages. We've talked about all of these indicators in this channel, so we can leave the link in the description, or you just check out other channel videos. Now, to enter the trade, enter a long trade after the confirmation candle closes, and you should enter a long trade above the inverted hammer's high. Then place your stop loss below the low of the inverted hammer to manage risks. Now, the next candlestick we are going to be looking at is the hanging man candlestick pattern. A hanging man candlestick pattern appears after an uptrend and signals a potential bearish reversal. This pattern signals a weakening bullish momentum and the potential for sellers to take control. How do you identify a hanging man candlestick on the chart? Now, first, a hanging man candlestick has a small body. The small body near the top of the candlestick shows that the opening and closing prices are close despite significant selling pressure during the start of the session. It has a long lower wick or shadow. The long lower wick must be twice the length of the body, indicating strong selling pressure that pushes the price low before the buyers pushed it back up. A hanging man candlestick has little or no upper shadow, and a minimal or absent upper shadow emphasizes that the session was dominated by a downward movement. Most times you will notice that a hanging man candlestick forms at the top of an uptrend or near a resistance level, signaling a potential bearish reversal. A hanging man candlestick forms when the market opens near the session's high and sellers drive the price significantly lower during the session, creating a long lower wick. This price action reflects selling pressure despite recovery, indicating that buyers may be losing control. How do you trade a hanging man candlestick? Like with other candlestick we've discussed, you want to wait for a confirmation. I know you want to enter the market and just make profit, but be patient. Don't let your emotions drive you. The fact that you've seen a hanging man candlestick does not mean that it's time to enter a trade. Wait for confirmation. If the next candlestick that forms is also a bearish momentum candlestick, then yes, your signal has been confirmed and you can now enter a sell position. You also want to combine the hanging man candlestick with resistance levels. A hanging man candlestick that forms near significant resistance zones is more reliable than a hanging man candlestick that just forms at any point on the chart, even though it's at the bottom of a downtrend. Like with other candlestick patterns, you want to also use indicators to confirm whether the asset is overbought, oversold, if there's a bullish or bearish momentum, trading volume, and you can also use Fibonacci retracement tool to also confirm your signal. To enter a trade, enter a short trade after the confirmation candle closes, and you can enter the trade below the hanging man's low, and then place your stop loss above the high of the hanging man to manage risks. Now let's move on to the last candlestick on our list, which is the spinning top candlestick pattern. A spinning top candlestick pattern is characterized by a small body centered between upper and lower wicks that are nearly of the same length. A spinning top candlestick represents market indecision, where neither buyers nor sellers have gained definitive advantage during the trading session. This pattern can appear both in an uptrend or a downtrend, signaling potential pause or reversal. How do you trade a spinning top candlestick pattern? First, you want to wait for confirmation. Wait for the next candlestick to confirm whether the market will go in a bullish or in a bearish direction. Then next, you want to combine the spinning top candlestick with support and resistance. When a spinning top forms near key support or resistance zone, it most likely signals a trend reversal. You can also combine the spinning top candlestick pattern with indicators. To trade a spinning top candlestick, you can enter a trade after confirmation of the pattern with a subsequent bullish or bearish candlestick. Place your stop loss below the spinning top's high or low depending on the trade direction. Now, I believe that when you see a doji, a hammer, hanging man, inverted hammer, or a spinning top candlestick on the chart, you are able to make meaning out of it and make profitable trading decisions with it. Now, if you followed our videos on technical indicators, Fibonacci retracement, support and resistance, and then this video on single candlestick pattern, you will see how all of this is intertwined. You would see how you can use a single candlestick pattern confirmation to confirm support or resistance, or to confirm the signal from Fibonacci retracement, or to confirm the signal from your indicator. So you see how all of these are intertwined. And if you can combine your knowledge of candlestick pattern, Fibonacci retracement, support and resistance, and technical indicators with, of course, fundamental analysis, you would see that you'll be able to build a solid trading strategy. So I really hope that you found this video helpful. In subsequent videos, we're also going to look at bearish and bullish candlestick patterns. And in this video, that's when we're going to look at candlestick patterns that are formed by two or more candlesticks. So you want to stay tuned. And If you do not already know, these videos that we make on YouTube are just a part of our free products for beginners in forex trading. Now there's so much scam out there, and we are trying to minimize this as much as possible. And that's why we've created free trading tutorials here on YouTube to help you build your own trading strategy as a beginner. And we also have a free tool for you. This tool is called My Trading Land. Just visit mytradingland.com and sign up. It is free of charge. And there we have a community that allows you to interact with other traders, so you can verify your signal or your decisions with other traders before you make them. On this tool, we have free economic calendar for you to stay updated with events that may affect price movement, as well as news and forex trading session to know the current session that is happening, so you know the best currency pairs to be trading. In our video on currency pairs in forex trading, we explained in our video on forex trading sessions, we explained how different currency pairs are best to trade during different sessions. So on My Trading Land, the forex session 2 is useful to knowing which currency pair will be the best to trade depending on the session that's going on. You'll find that tool very useful, and it is free of charge. We're not charging you any dime. I hope you found this video helpful. If you did, don't forget to give it a thumbs up, and of course you should subscribe, and you should visit My Trading Land to make use of this free resource that we have for you. Thank you and happy trading.